How does the stock market work? Greetings everyone! Looking for the answers on anything related to the stock market? Do you have questions on what stocks are, how they work, or how you can make money off of them? Then congratulations on finding this channel. You're in the right place. In this video, I'll be talking about stocks, and we'll be answering any questions you might have regarding stock. So make sure you stick around to the end. This content is for educational purposes only, and should not be treated as a piece of financial advice. If you have yet to subscribe to our channel, then make sure you do so now, so that you don't miss any of our important updates. Let's go! While there are various ways to raise your net income, investing in stock is one of the best and efficient ways. Although, people tend to shy away from it because of the risk involved. However, there is good news. The risk can be managed. The tactic to excelling in stock market is having a full understanding of it. This way, you manage your investments better. In this video, you will learn everything you need to know about stocks, risks, and protecting your investment. Before we delve into the definition of stock, it is important to note that the words stock, shares, and equity are used interchangeably, so you don't get confused along with the video. What is a stock? A stock represents your ownership of a fraction of a particular corporation. Simply put, it is an investment that shows you own a share in a particular company. Owning stock in a company makes you a shareholder of the company and gives you the stockholder title. Having stock in a company entitles you to a fraction of the company's assets in relation to the amount of stock you own. For example, having 200 shares out of 1,000 shares of a company makes you entitled to 20% of the company's assets and earnings. However, it is important to note that stockholders do not own corporations, although they have shares issued by the corporations. But what happens if a company you're a shareholder in has to dissolve? Well, in this case, you will not be at a loss. You get to claim part of the company's residual assets and earnings. So how does the stock market work? We are all familiar with the way buyers and sellers negotiate and make trades at the auction house, right? The stock market operates in a similar way. Basically, most companies list their shares on the stock market to raise more money to grow their business. So, after listing their shares on the stock market through a process called Initial Public Offering, IPO, investors purchase these shares. The prices of the stock are set based on the supply and demand of each stock. Now here's one of the interesting parts. Investors can buy and sell their stocks to other investors. In this case, the buyers will bid for the stock. The buyers with the highest bid gets the stock. Although most times, the prices are always a little lower than the seller's price. However, for a trade to occur, a buyer and seller must agree on an amount. Moving on to how to make money off stocks. One way to make money off stocks is by extending your time in the market. You should note that investing in stock is not a get-rich-quick platform. You have to remain in the stock market for a reasonable amount of time. Let's assume that after investing in a particular company, the stock market's average return is 20% per year. If you don't remain in the stock market for some years, you'll miss out on the benefits. This is a major reason why people don't earn. They don't stay invested for long, and they end up missing out on the returns. Experts can advise investing in stock with a particular amount you can forget for at least 5 years. Another way to make money off stock is by reinvesting your dividends. What do I mean by dividends? Dividends are the profits shared by a corporation to its stockholders, depending on the number of stocks owned in the company. So instead of getting your dividends, you could reinvest them. Why should you do that? Because when you reinvest it, you get more shares, and this increases your earnings faster. Please note that the dividend you receive is also one of the ways of making money off stock, but reinvesting it brings even greater income. So now, let's talk about the different types of stocks. Although there are different types of stock, in this video, we will be focusing majorly on 3 types, which include value stock, growth stock, and dividend stock. A value stock is a share of a company that trades at a lower price compared to what the company's performance indicates. A value stock has a bargain price as investors capitalize on its inefficiencies in the market. Some characteristics of value stocks include high dividend yield, low price to book ratio, PB ratio, and low price to earnings ratio, PE ratio. price-to-book ratio is a ratio used to compare a company's market value to its book value, while price-to-earnings ratio is the ratio of a company's stock price to its earnings per stock. All of these parameters are used in weighing company stocks if they are overvalued or undervalued. It is important to note that value stocks are most likely to appreciate when the stock market realizes that it is truly underpriced. The next type of stock we will be examining is the growth stock. It is a stock in a company that is expected to grow at a faster rate than the average growth for the market. Growth stocks do not pay dividends, and this is because the companies reinvest all their earnings to skyrocket their growth in a limited time. So, in this type of stock, investors earn money through capital gains when they finally sell their stock in the future. Growth stocks have a high PE ratio, and investors pay a high price to purchase this stock in anticipation to earn a huge profit if the company does well. Value stocks are always put in contrast with growth stocks. The last type of stock I will be talking about is the dividend stock. A dividend stock is a traded company that distributes its profits to its stockholders through dividends. It is mostly paid out quarterly. Dividends are paid to stockholders for a lot of reasons. It could be paid out if the company isn't reinvesting a particular amount, but it is a way of sharing the company's profits. Finally, let's relate the returns on stocks to bank savings. While bank savings allow your money to earn interest at a slow rate with a very low risk of losing it, the stock market allows a high growth rate with a high risk of losing your money. If you would ask me, I would take the risk, because why not? After all, life itself is a risk. Delving more into the returns on stock and bank savings help you store your money safely while earning interest. And no matter what happens to the bank, you would still get your money back, which makes it a perfect choice for keeping a particular amount you don't want to lose or that would be needed in a short time. However, your earnings are limited and are small compared to what you earn on stocks. You earn interest based on a certain percentage that the bank gives you on your deposit. So let's say your account offers you 0.05 interest per year and you have $2,000 in the bank. Your annual interest will be $10. While bank savings have just one way to earn, there are diverse ways to get returns on stocks. Stocks are shares of publicly traded companies, and returns are gotten from dividends. You could also get profits from raising stock prices. Remember, I stated earlier that not all companies pay dividends. You can still make your money when the stock price rises, since owning a stock makes you own part of the company. If the company does well, then the value of your stock automatically increases. So there you have it, some basic and important information you needed to know about stocks. Interested in learning more? There is more where that came from. Kindly browse through our channel for more educating and helpful videos. Don't forget to share this video to other people like you who are interested in learning about stocks. Until next time, take care.